Hey everybody, welcome back. Learn Commercial module number 11. Today we're going to talk about financing and 7S, 7 streams of income, which also happens to be the name of my company. I'll be able to see that, 7S, maybe for a second. There you go. All right, so let's just jump right in. And again, I do appreciate y'all being here. I'm going to share my screen. There we go. All right. Let's get into it. The fun of lending. Now, we're going to scratch a lot of the surface stuff on the lending because the lending environment is changing so frequently. Like right now during COVID, things that were happening last year, 5 months ago, aren't the same anymore. So this is a general overview because the lenders are changing so frequently. The underwriter regulations are changing. They're lending 1 week on certain items and not the next. So do not ever try and become the expert on the lending. Understand the value in what typically takes place and how you can help guide the transaction in the right direction. But as far as saying this will happen, this can happen, this is the way it is, don't do that. Just refer it to a lender who can answer those questions because things are changing often and you don't want to get to misspeak and have them waste their time, right? Ever. So just don't play the expert here. Just refer to the experts, like a lot of the stuff, right? This is not part of our world. This just helps our world with the transaction and can be a big, major factor in getting it done. So make sure you have some contacts. Like one of the homework items is go find 3 lenders in your market. You need to have multiple lenders and understand what their fairway is that they like to lend on. So when you do go there, you have the go-to. And you know they're going to be there to answer your questions, answer your texts, because they know who you are. You're not just a random like, hey, Jim, I got your number from Bob down the street. I had a question. Like, who is this, right? Start the relationships now. All right. So we're going to go over the different types of loans and what that looks like. Now, again, hyper-local usually works better for more unique product. If you're an owner-occupant looking to buy a building, it almost doesn't matter. Most of them are going to be really close because that's everyone's fairway. Everyone loves owner-occupant for the most part. Now, that could only be conventional, though. You may want to go SBA. And so that may not be your local Chase Bank. They may not have a great SBA person there you can talk to. So I always recommend going local if you can, because they generally give you better rates because they're looking at your market as opposed to the entire country. And yeah, so I also like the brokers. So going with the lending brokers, their job is to know all the different products at all the different institutions so they can help guide you in the best route to take based on your current condition and position. So you may only go to Chase and Frost Bank. Well, they may know some life insurance money from a company in California that's starting to lend in Texas. So it may cost you half a point, maybe a full point to get it done, but over the long haul, better rate, better interest, and they can get it done. So I encourage everyone, if you have an amazing relationship with your bank, fantastic, but don't discount talking to a broker because their job is to know the market. They understand what everyone has, or we hope, and so they have the best amount of options possible because there can be some big differences. Just the other day, one of my lenders down in Austin, he was talking about HUD or FHA options on a multifamily, and my borrower said, I had no idea that was even available, but they would have never known unless they talked to him. All right, so types of loans. Of course, we all know SBA, right? Small Business Administration, which has recently been packed with the PPP, Payment Protection Program with the COVID stuff. They've been just running through billions and billions of dollars. That's slowed down, and now they're working on educating people on how the payback or non-payback looks like. So they're ramping up again on funding more traditional transactions. So we're going to talk about that. We're going to talk about certified development company. That's just an SBA 504 loan. Until I started developing this class, I'd never heard anyone call a loan a certified development company. So don't worry about hearing that terminology. It's going to be an SBA 504. Conventional loan, commercial bridge loan, hard money loan, and conduit loan. So the ones that I always hear about, SBA, conventional, bridge loan, hard money. I don't hear about conduit loan because conduit loan just go into the CMBS market, which I know they're there, but I have not had to deal with that conversation with anybody yet. I know my buyers have, but I have not been privy to it. I didn't need to. And certainly not a certified development company, just SBA. Okay. So SBA, Small Business Administration Loans. SBA.gov has a ton of information. You can jump over there. It's pretty easy to follow and read through. But these are the different SBA loans they have available as well. So it's not just one type of program. They have your standard 7A loan, a 7A small loan, a micro loan, SBA Express, export working capital, international trade, preferred lenders, Veterans Advantage, cap lines. In my experience, this is a great to have I like SBA. It's a reduced amount of money up front. Your interest rate is going to be a little bit higher, and it's going to take longer to get qualified. That's the downside. But the good side is it's less money out of pocket. So usually it's an SBA comes into play if you're a 50% owner, 51% owner occupant, then you can get a SBA loan because you're occupying the building you're buying. So 51 or greater, SBA is good. Outside of that, you're not going to really qualify unless it's for working capital or something else. But again, that's because you own and operate in the business. Let me see if this next slide right here, I'm going to stop sharing this real quick, and I'm going to share the SBA page real quick just to show you guys. Let's see, SBA. Okay, here we go. All right, so this is like an SBA info.pdf that they have on the SBA.gov. So this is going to go over, the guaranteed loan program, what those maximum limit interest rates, the use of the loan proceeds on that left column right there. They go into a lot of detail. Maximum loan amount, $5 million. Use of loan proceeds, it talks about what that can go for. The fees. Then you have SBA Express, it talks about what that is. SBA Veterans Advantage. And then under Community Advantage Loan Programs, it talks about all the other development centers and what areas. On the middle right, it talks about 504 Certified Development Company loans, which we'll talk about here in a second, which is the ones I've never even worked with. You have a micro loan, which is up to $50,000 for like equipment, machinery, or inventory. So, they just have I think there's a little more here. Yeah. And there's the lenders that participate in SBA. Now, it's not hard to find an SBA lender. They're everywhere, and SBA.gov's got a plethora of information that should answer most of your questions. And again, don't be the expert. Just send your clients here if they want to do their own research, if they're an engineer mindset, but better yet, have them contact one of your top 3 lenders and just have them ask questions, have them send them information, because this could be great right now, but something could have changed. Okay. So the SBA does have good information, but always ask the professionals who are doing this on a day-to-day basis. I'm going to go back to the slide deck. Okay. All right, so CDC, Certified Development Company, SBA 504 loan, right? Again, I've never heard that. I just showed you a brief little mini paragraph on the SBA info.pdf. There's that link right there that talks about it. I'm going to show you all this CDC sheet real quick. Where's that CDC sheet? There it is. Okay, so here it is, the CDC. Talks about what is the 504 loan program. Talks about CDCs in general. And it's a certified development company. It's a nonprofit corporation that promotes economic development within its community through 504 loans. They are certified and regulated by the SBA and work with SBA and participating lenders to provide financing to small businesses. There are over 260 CDCs nationwide. All right, so the structure. Loans are typically structured with SBA providing 40% of the total project costs. A participating lender covers up to 50% of the total project costs, and the borrower contributing 10% of the project costs. Under certain circumstances, a borrower may be required to contribute up to 20%. So on a typical SBA, we can get down to 10 or 15% down payment by the buyer. Now, this just shows a different way where you not only have the SBA lending, but you have the SBA through a 504 and a traditional lender, and then the borrower, all three as opposed to the two. Now it says for examples here, loan example, building purchase, land, renovation, furniture and equipment, total $1 million. So, and they run through it. If you look at that loan structure, $500,000 first lien, $400,000 second lien with the 504, and then $100,000 from the borrower, which would be 10%. Now, this is available if you follow that link. So I'm not going to read all this, of course. I've never had to do a CDC loan. Usually mine's just straight through SBA. And even if it was, I wouldn't go into this. Just send them to the SBA lender, whether it be working capital, buying equipment, anything that they have to buy for their business or buy the real estate for their business. Anything encompassing all of that can be rolled into SBA. And the SBA lender will tell you the best route based on what is available in the certain circumstances that you're in. So again, don't be the expert here. Just send it off to SBA. Just say you probably have some options here. So let's go explore those options. All right, so conventional loan. This is more typical, especially on the investment side. So there's two types, owner occupied and investment. To be the owner occupied, you need to occupy more than 50% of the total space. Anything else falls into an investment. So when you are occupying it, you are going to get favorable terms because it's more secure. Issued by banks or lending institutions, that can be banks, credit unions, life insurance companies. I mean, life insurance companies, guys, they invest billions of dollars into commercial real estate every year. Hedge funds, private financial institutions. I say all those because that's why it's so important, in my opinion, to talk to a broker. Even if you don't go with the broker, you're going with your local bank because they have a better rate. At least you'll understand what options are available to you given your specific situation or your clients. So I definitely encourage you all to at least talk to brokers and just hear them out, hear what they have to say, and just ask that question straight up. Why would I go to you as opposed to my bank? And just see what they say. They have a lot of information. I got two lenders I go to in Austin, and they know pretty much everybody. They know where all the money is, and they may not know everything about what is available and why, but they know who to contact to find out. All right. Yeah, so issued by the bank, they're secured by a first lien position on the subject being financed. So they will always take first position on the loan. Where if you looked at that CDC a minute ago, the normal lender would be in first position. The 504 loan with the SBA would be in second position. That's kind of unique because normally on a general SBA is number one. Okay, so your debt service, your DSC is your debt service coverage ratio. It needs to be somewhere from 1.15 to 1.55%. That just means your NOI, your net operating income, needs to be at 1.15 to 1.55x the debt service. So they need to make sure the income you're bringing in after expenses has a cushion of 0.15 to 0.55 above the debt service. That's what they want. It can't be 1-to-1 because if anything happens, you're upside down, you can't pay it. The property can't be self-sustained that way. So it's got to have that cushion. Terms, and that's on the debt. That's not on the total purchase price, right? Because you're going to put 20% down or more. Terms range from 3 to 15 years with amortizations ranging from 10 to 30 years and a rare few at 35. So again, when you're lending on commercial real estate, there's fixed rate for 10 years, due in 10. There's fixed rate for 5, due in 10. There's fixed rate for 10 or 20, due in 5. I mean, there's different ways you can do this, depending on what rate you need right now, if it's going to be interest-only loan. But again, I don't want y'all to be the expert. Just know there's lots of options in the financing can play a major role on making this deal work. Like if you're buying a property to force that appreciation and sell within your 3 to 5, an interest-only loan is fantastic. You're reducing your monthly expenses. You're reducing your expenses while maximizing revenue for your exit. So just talk to lenders. They'll evaluate this alongside with you. We're going to actually have one of my buddies, Hans, evaluate a multifamily transaction on the back end and say, this is why I evaluate this way, that way, etc. And it's going to be an eye opener. It'll be great. But just don't be the expert. Just know the financing is going to play a big role. So if this is not their first purchase, they probably have contacts. They've probably already done it. They probably understand the game. If they have not, you need to make sure they're in contact with a lender that you like or multiple lenders to get that ball started, because the lender is going to ask things they've probably never given before, and they need to be prepared. And you won't be the bearer of bad news. You don't want to kill their dream, right? Let the lender do it for you if they're going to say, well, actually, we can't do this. Let them say why, and then let's find a game plan to make it so it's a reality. Yeah, this is the most common type of loan, conventional. Typically, it's 25 to 30% down for an investment product, but right now, during this COVID timeframe, we're seeing lenders need 35 to 40 and a year's worth of reserves on income due to the uncertainty. So when things were happening beginning of the year and last year, they're just not happening right now. So be prepared for someone to say 25 is not going to be enough, and your client may be upset, but that's just our reality right now. They may need to bring more cash to the table. Yeah, so rates will typically be a little bit higher than the residential rates because you're not living there, right? It's an investment. If you can, life insurance money, it's probably the cheapest money you can get if you can qualify for it. Just an FYI. All right, a commercial bridge loan. So this is a form of short-term financing designed to bridge the financial gap between current and future circumstances. Typically used until more permanent financing can be put in place, as this form of money is more costly. It's kind of like hard money. It's really close to hard money. So the typical terms here, 1 to 20 million. Look at that interest rate, 9 to 11%. So it's almost right there with hard money. Loan terms usually 6 to 12 months, but longer if needed. Up to 80% LTV. Your fees, look at that fees, 2 to 6% as a fee, right? So if you only need $1 million, 2% is still 20 grand, 6% 60. You still have appraisal fees, escrow, title fees, and you may have a prepayment penalty. And we'll talk about that a little bit more here in a moment, I believe. If not, I'll come back to it. But the repayment, it's unamortized, one-time repayment at the end of the term or sooner. Interest-only payments each month with a balloon payment at the end of the term or sooner, and amortized, or those are the two, you're amortized or so unamortized, or you're going to be amortized. A lot of these, they're just paying interest only and having a lump sum due. So you're not paying principal, just interest. And the collateral, they have to be in first position most of the time because it's high risk. High risk people don't like, that's why they have 9% interest here. A lot of this could be like, you're buying, you just paid cash for a vacant office building, and you need a bridge loan to renovate the entire building, renovate the top floor, add HVAC units until you can get it occupied and then flip out of it, or refinance into permanent debt. Permanent debt may see this as too risky, so they're unwilling to lend in its current condition. You'd use the bridge loan in order to make it a reality, and then roll this into permanent debt so you're not paying that 9 to 11%. All right, so hard money. This is lend based on collateral securing the loan, as opposed to typical lenders look at the borrower and then the asset, right? So if you can't repay, they take the collateral and sell it. So when they lend money, this is basically my property until you repay me back, kind of like that. They're the lender, they're the mortgage, they have the note. If you can't pay them back, they're coming after it. Typically short-term loans from 6 months to 5 years. Gives you the ability to move and close quickly. I mean, some of these guys can close in a week, especially if you have a relationship with a hard money lender, right? Don't forget module 1, build your team. These are people you want to have in your back pocket, including lenders. They keep the LTV, the loan to value, pretty low, probably 50 to 70%. This gives them the ability to take the property and sell it quickly if they have to. product type, ideal situation for hard money. You see it all the time on the fix and flips, right? Zero money down. They use the hard money to buy the property, hard money to finance the repairs. And then when they flip out of it, there's still enough juice in there. They can pay everybody back and make a profit. And the flips, hard money's been the name of the game for them for a long time. Land loans. Sometimes lenders do not want to lend on land because there's no income. And if you're not financially strong enough, hard money may be the only way to go. But they're still going to want some collateral. They want something. They got to get their hooks in something. Construction loans. If a typical bank won't agree to do it, they're taking too long. You have let's say someone comes to you and says, if you don't close this next Friday, you forfeit your earnest money. You have all these fines, whatever it may be. We're transferring the property to another buyer because they can close. If your back's against the corner, hard money can bail you out. They can close quickly, all cash. You just have to have the ability to repay them, right? When buyer has credit issues, that can also work. When real estate investors need to act quickly. We've seen hard money fund in weeks as opposed to months, but there's a high cost associated. We see rates from 10 to 15%, as well as points up front can range from 2 to 4%. So very high interest rates. Different states range, but typically speaking, they can't go above, I believe it's 17 or 18%. They got to cap it. So for that interest rate and the points up front, there is a number. I can't remember off the top of my head, but it's 17 or 18%. So that's why they stopped there at 15. But double check your numbers and make sure the deal still works with this upfront and high interest rate. Now remember, this sounds like a crazy amount of money, but it doesn't have to be that bad. Let's say you only need $100,000 to renovate your house flip. $100,000, okay, you're paying, let's say it's $3,000. You're paying $3,000 to get the money in a week. And let's say the interest rate is, let's say it's the highest right there. It's 15 grand to get that money. Okay, well, how long is your flip going to take? More than likely, it's going to take you 45 to 60 days to get it all repaired, renovated. Let's say it takes you 3 months. Then let's say it takes you another 3 months to get it sold. Let's hope not, right? We want this done in like 30, 60 days, right? In and out. But let's say it takes you 6 months. Well, that's only half of the year. That 15% is not monthly. That 15% is for the entire year. So the reality is you're paying 7.5%. You're paying $7,500 plus your 3. You're into it. You're $10,500 to get this deal done that you wouldn't have been able to get to otherwise, and in a week. Now, if you're doing a flip, there better be more than $10,000 cushion in there. You need to have a 20, 25, 30% margin so you can afford to pay everybody back. So it's not as bad as it seems. It seems like a crazy number, but if you need money now, 7.5%, who cares, right? Just get it done. All right, so conduit loan, also known as a CMBS, commercial mortgage-backed security. If you watch The Big Short, they go into a lot of the CMBS market and how over-leveraged and the collateralized debt obligations and all this stuff was mismanaged, if you want to call it that, back in the 2008 crash. Now, then the Dodd-Frank bill came in and it over-regulated the industry. Commercial still lives in more of a gray area than residential, but you know, I'm going to show you this CMBS loan sheet real quick. Where is it? Here we go. All right. Okay, so what is a conduit loan? A conduit loan, also known as a CMBS loan, commercial mortgage-backed security, is a type of commercial mortgage-backed that is packaged into a pool with other similar type loans and securitized and sold on the secondary market to institutional investors. All right. The loans in the pool are held in trust and serve as collateral for the mortgage-backed security. So you'll hear the term defeasance, which I mentioned earlier that we'd come back to. Now, the defeasance penalty is because when they are packaged in the CMBS pool, they have an expectation of you holding the note for 5, 7, 10, 15 years, right? All of these loans were packaged with that in mind. This is the revenue they expected to receive over that 5, 7, 10-year period. If you terminate and you have to pull that property out of that pool, there's a big penalty because they're not receiving the money that they bought that loan into the package for. So in some of these defeasance penalties, like we had one let's see, there's a $4 million loan, and then the fees and penalty was like $750,000. So unless you assume the note, the deal was dead. It doesn't make sense to tack on that cost. And so you do need to understand if, in fact, I heard a crazy one the other day. The crazy one was this guy refied, did some weird, crazy, I don't know the details, but he did a crazy refi. And in the defeasance language, he couldn't sell this property until 2035. Like, that's 15 more years. I mean, I couldn't believe it. I haven't seen the details, but someone told me that, and I was like, that sounds absolutely crazy. All right, let's keep going. All right, so how to prepare for your commercial loan. Be organized, vet the lender, right? Research lenders, ask the lenders questions, be confident, send all requested docs ASAP, as soon as they ask for them. Have all documents ready, right? Dress and act the part when you go to meet them. Bring an executive summary of what you need the money for. Know the details of your business investment, of your business or investment. Have a what if in place. What's my plan number 2 if this doesn't work? Show your financial capacity and experience. Have an exit strategy, right? Have this ready if for investment, right? We need to have the T12, your trailing 12 months of revenue and expenses. Rent roll, borrower pro forma for expenses, and offering memorandum if possible. Ideally, also have bios and PFSs for any guarantors. PFS is personal financial statement, okay? So I say that, but a lot of these lenders are busy. And if you don't have all their docs, you're going to the back of the pile until you get it to them. So just have everything prepared. And when they ask for it, get it back to them as soon as you can. Okay. All right. Now, how to get to 7S, 7 streams of income, which is why we named the company 7 Streams, my brokerage arm, 7 Streams Commercial Group, because the average millionaire has 7 streams of income, right? And that's what we want to create here. We want to create millionaires through this process. So these are the 7 streams that you typically see with these millionaires: earned income, profit income, interest income, dividend income, rental income, capital gains income, and royalties. Now the last slide is a bit misleading because most millionaires don't make big money in all 7. Usually they make it in 2 to 3 of these. They can certainly have 7 streams of income, but they can be 7 different real estate investments or owning 7 different businesses. So they don't all have to cover all 7. They just have 7 different streams. In our business, the business of real estate, we primarily look at, number 1, earned income, our real estate brokerage activities. Number 2, profit from selling assets we own, personal house, investment property, or business. And then rental income, owning investment property and leasing it out. That's just typically what the realtors have, right? They were playing in our own backyard. Once you get to a certain level, number 3 starts looking real appealing as well. Number 3 on the main list, which number 3 is interest. If you have the liquid capital and know how to handle it, lending money as a hard money lender can be very lucrative. 2 to 3 points up front, 10 to 12% interest, loan terms of 1 year or less, right? You're securing the collateral, the asset with the money you're lending. You get high fees up front and you get your money back quickly. So of course you want to vet the borrower and the property, but it can be quick turnaround on your money. You should already have your brokerage activity in your home, profit when you sell, appreciation, etc. Do you have more? How can we get you to 7? Do you own investment property? Do you own another business? Do you have profit or revenue share? Do you have any stock, right? Those are all revenue streams. Just because they're not paying you monthly doesn't mean it's not an income source, or could be an income source if cashed out, right? We need to set the intention and the action items to achieve the desired outcome. Remember, we often overestimate what we can do in 1 year and greatly undervalue what we can in 5. So we all need to have a sheet like this whether it be a 411, a goal sheet written on your window in your bathroom, wherever it is, you need something, a day one goal. What am I doing today in order for me to reach my 5-year goals, right? Week 1, what are my goals in order to get me to my 5-year? Q1 goal, 1-year goal, 3-year goal. And this is not just business, this is personal. I haven't gone on a vacation in 3 years. Next year, my goal is to go on 3, whatever it is. I want to double my production next year. Time block, right? Are your goals that detailed? If you don't have a crystal clear vision, we need to keep working at it. I have these written on my bathroom window. I see them every day. Why is this important to you? Don't just talk the talk, own your goals. Right? That's the only way to get to 7 streams of income and 7 streams that can afford you the life that we all deserve. So action item number 1, find 3 lenders in your area. Ask the other realtors or friends for recommendations if you don't know. Again, the broker community is our friend. Find out what they specialize in. Take them to coffee. Who is their ideal client? What is their perfect fairway and how far can they deviate? Ask, do you know anyone needing real estate that I can assist with, right? I'd really appreciate the opportunity. Always ask for the business. Complete the following. If you could write down your top 3 wins that could happen in commercial real estate, what would that be? Focus on multifamily, buy a retail building, only work commercial. Think bigger and let's rewrite those goals. I don't need to say 10x, but let's think bigger. If you want to buy 1 building, why not 10? Why not 5? Why not 7? Why not 3? Don't think small. We're already thinking. If we're going to be thinking anyways, let's go ahead and think bigger. If you have big, audacious goals and you're driven to get there, even if you fall short, you're going to be well exceeding any small-minded goals that you may have had before. Just make it a little bit painful. Right? How can we help you get there? You know, one of the beautiful things about commercial real estate is you can literally be 1 deal away from being a millionaire. If you're already a millionaire, you could literally be 1 deal away from doubling, tripling, 5xing your net worth. That is amazing, right? Not many people have the opportunity to play in a field that has that capability. I'm not saying it's going to happen, but we should all strive for bigger and better. So stay educated, lead generate every day, time block, follow up, educate, lead gen, follow up. Get into the community. Let's ask questions. Let's buy some property together and let's make it happen. Thank you all so much. We'll talk soon. See you in the live calls. Thanks, guys.